Welcome back to MIC's video series, Trading Basics. This is episode 3. I'm your host, Joe Kelly. I'm one of the moderators of the room. Alright kids, we're getting straight down to business. No lollygagging. We're going to talk about the pattern day trader rule. What is it and how to deal with its challenges? Any customer who executes 4 or more day trades within 5 business days gets restricted from closing any more positions for 90 days. That qualifies you as a pattern day trader. That means that you get 3-day trades per rolling 5 days, 5 business days without restriction. So what is a day trade? A day trade is when you open a position and close a piece or all of the position within the same trading day. That means during any of the 3 trading sessions, whether that's pre-market, regular session, or after hours. So how do you trade within these PDT guidelines? For example, if you want to do day trading, well, you have to be very, very selective and only trade the 19, 20, and 21 blackjack hands. In reality, this should be done regardless of PDT, but PDT makes it so much more difficult to trade the lower odds setups and still have the opportunity to trade the better odds setups when they come. If you don't get your execution, you don't trade. Simple as that. If you don't know what your ideal entry is, you should avoid and record the outcome. This helps you gain future confidence to know when to pull the trigger, to be ready to pull the trigger when you're standing on the front lines looking the enemy in the eyes. Now let's break down into an actual trade example of how you could scale into a position while under pattern day trader. Let's pick a stop and then pick a profit target. This is what you should do when you're making a trade plan immediately. You need to have a stop and a target and make sure that there is enough range. That means meat. Take the easy money. Don't try to nail the top and the bottom. You don't need to be perfect. So this trade example here is based off of the chart on the right side. Let's say that we want to buy the dip into the 5-minute 50 period exponential moving average with a risk at 5% below the 50 EMA and a profit target at 260. I'll break that down what I mean exactly. So that means your stop is going to be equal to the 5-minute 50 period moving average, which is 218, and you got to times that by 95% because we want 5% below 218. It's the same thing as if you wanted to calculate SSR or short sell restriction for a ticker on specific days. You look at the previous close and you times it by 90% or 0.9. That gets you the 10% below, which is then going to be SSR trigger.